The economy is like a huge cruise ship, right? It's going a certain direction and it takes a lot of effort and time to turn directions. And you can generally predict with some level of confidence, these kind of, we call them short to midterm trends and things that are happening that are kind of separate from the, headline narratives and the, newsreels that you see.
I have a dream.
With great power comes great responsibility.
I could do this all day.
This is it. Don't get scared now.
They may take our lives, but they'll never take our freedom.
Cinderella's story out of nowhere.
It's in the home. That the only thing we have to fear is fear itself.
Welcome back. Welcome back to Capital Hacking. John, it is wonderful to have you on the big show.
Josh, we have such a great show lined up for our listeners today with Ben Fraser of Aspen Funds, guys.
It makes you want to go skiing.
Oh, yeah. Well, he's going skiing this weekend in Breckenridge. I'm kind of jealous about that. But they have raised over $125 million to fund their $250 million in assets that they have. The beautiful thing behind it is that they started with friends and family and then worked out from there. So they're taking care of the home team. And you guys are in for a treat as he talks about how he stays ahead of the trends.
Wow. That is a great intro. Ben, I know you're listening to this. Was that not the best intro? Now, the reason we also love this guy is he happens to be a co-host of a wonderful podcast. We're going to be on here soon. It's called the Invest Like a Billionaire podcast. I'm sure you're checking it out right now because it's awesome. Yeah. But this group, Aspen Funds, it's a true alternative investment focused group. And I love how they lead, and this show is a great example. They lead with a lot of economic education, and he'll talk a lot about the mega trends. Now, he didn't think about it, how I was thinking of Marvel movies the whole time. He kept saying mega trends, and I'll tell you right now, if you get to the end of this, you will have been educated on inflation at a new level. You'll understand how to invest against the trends, the mega trends. With them, I should say, with them in front of them. And you'll be very well rewarded because this is a power-packed masterclass episode.
Let's go.
Welcome back to Capital Hacking. John, Edwin, it's so great to have you on the team.
Thank you, Josh. It is exciting to be here with Ben Fraser.
Ben, welcome. Welcome on the show. Come on board. And we're going to do the classic, tell the listeners a little more about yourself. They haven't gotten to know you like we have yet. Tell us where you live, family life, and what you do, brother.
Well, I am thrilled to be on the Capital Hacking train here, and it's exciting. So, yeah, a little bit about me. I'm a principal at Aspen Funds. For those that are not familiar with Aspen Funds, we operate in the alternative investment space, just like you, Josh, and we are multi-asset class focused. So we are what we call macro-driven alternative investing focused. So we look at macro trends and what we see going on in the economy, and want to position ourselves to be beneficiaries of rising tides, and then find deals and operators in those trends that we like, and put together really good deals. So we've been doing this for about 10 years, have about $250 million of assets under management, and have a lot of fun.
That's a nice succinct. The only thing I don't know if we know, Ben, do you have a family? Are you father, or do you?
I do. I have 4 kids, so I'm trying to be like you, and I have all girls, so I'm still going. So we're
Ben with 4 ladies plus a lovely wife. Wow.
That's right.
How old are the girls?
Love it. So we actually just moved all to the odds, so it's really easy now.
Yes,
it's 9, 7, 5, 3, and I get to say that till May. So
yeah, we have some of that situation. So that's plus your lovely wife. What's your wife's name? And where is home? Laura?
We're Kansas City. Yep.
All right.
Yep. Good old Midwest.
That's what I love about it. I wanted to get that out because, sometimes these shows are dominated by the coasts.
Yep.
And I love my friends from the middle of this beautiful country. Now,
right.
Matter of fact, I heard you say you were going to ski. Are you skiing this weekend in Colorado?
I'm going to try. I don't know how good the powder's going to be, but I'm definitely going to do it. So, yeah.
It's fantastic. And Ben, Aspen Funds, very well-known fund. What got you into that? Can you give us a little backstory on how you got involved in creating Aspen Funds?
Yeah. So my father's actually one of the original co-founders. Him and his partner started 10 years ago. So I only joined 5 years ago. And they started really kind of post Great Recession and found a very unique niche in distressed mortgages. So it was a good time to get into distressed mortgages. And there's a whole backstory of how that even happened. But really saw a unique opportunity. And at that point in time, it was, hey, let's just do a little friends and family fund. There's a unique opportunity. It was never expected or intended to be more than that. But 10 years later, we're one of the bigger players in the space, in the mortgage note space, and we continue to operate those businesses and fully vertically integrated with asset management and acquisitions and sourcing for those funds. But it's somewhat of a counter-cyclical business. So as you'd imagine, a lot of these mortgages are kind of a result of challenges with borrowers because we're buying a lot of times distressed mortgages from banks, hedge funds, and other financial intermediaries, and it's kind of somewhat counter-cyclical. So we're kind of in a long positive economic cycle. It's harder to find good notes, but hey, there will be another economic cycle. Maybe
Maybe we're in it now.
Too distant future. So we'll see.
Yeah. Right. So you guys were buying tranches, and for those of us, we've had a few other investors on the show over the 250 plus shows explain it, but it's always fun to just kind of grasp that first core business. So for those listeners who have not heard of that class, and then we're going to go into other things, but just define how that works. What do you mean you can buy a mortgage note and who sells them to you?
Yeah, exactly. So it's a little bit of a shift in your mindset of normal real estate investing, where we're not buying the asset, we're actually buying the debt. So we don't actually control the asset. We don't own the asset. We just have a right to the asset if our borrowers stop paying. And so, as we could talk about this for a while, but there's a lot of benefits to being the lender, versus the landlord. And so we call them, being a lien lord. You got to file the lien. And there's a lot of benefits because we don't have to pay insurance. We don't have to maintain the property. Taxes aren't our responsibility. We don't worry about tenants because our borrowers are generally homeowners. And so we're just receiving the monthly mailbox money for their monthly payments. And if they stop paying, we have the right to foreclose if we need to, though we generally don't. And one of the cool things about this business is we're generally buying them from banks or other hedge funds that are creating, this reperforming notes is what they're called, RPNs. And they're generally sold at discounts to par value or discounts to what's owed on the mortgage. And by doing that, it gives us some capital protection, but also gives us a nice yield. And it gives us a lot of margin to work with if we need to help borrowers out. So, we've been doing this business for 10 years. Our foreclosure rate is less than 2%. Wow. With our borrowers. And so we really, really try to help people. We try to, do well by doing good along the way. And, a lot of people that operate in this space are, not going with the same approach, a little more predatory. And it's like, hey, it's an entry point to buy it, be able to foreclose on the asset and take the asset in a discounted basis. And that's not really our approach. We don't want to own the assets.
So I love that you said you started out with friends and family because we always want to help those around us, right? Called them the home team. But you'd mentioned that you've raised about $250 million now, so 300 million, right? So obviously that's not just from friends and family. You've expanded. How did you come across these other investors? And what's the criteria there?
Yeah. So just to clarify, we have about $250 million in assets. We've raised about 120 million in equity. So yeah, we've been doing this for a little while, and it started out with friends and family. And then, as anyone that's trying to raise money, eventually those people run out. So you got to go find other investors. And so we went down a few different paths early on, working with institutional investors, working with family offices. And we have a few, smaller family offices that invest with us still, but we chose to go the accredited investor route, going with individual investors, retail investors that don't have the normal access that the bigger institutional investors have to these types of investments. And, on the front end, it was a little bit of a commitment to build out a investor relations team and build out a marketing team. It's a business in and of itself, really. Yes. But it's something that we're really glad we did. And, I forgot to mention on the front end, but we have a podcast that we have as well called Invest Like a Billionaire. And the whole point is just to educate individual investors about alternative investments. And that's why I love what you guys are doing. And we're trying to, join along with the same mission of helping people find out about these cool things.
Yeah, and you just said a trigger word there. Find out about these things. You also said access that normally a retail investor like us, people that aren't billionaires, don't usually have access to the types of assets that billionaires only really buy into. So we're going to break that down in a minute. We're going to talk about the other types of things you've learned about since setting up Aspen Funds. So for those listening, there's so much value packed into the next few moments. I hope you have a Tesla and you don't need to pay attention to the road, because this is a lot. Or if you're you're a treadmillister, then hold on to your handle there. So let's go into the idea of, first of all, I really love the idea of note investing. The more I think about it, there's a lot. I love the idea that you called them lien lords instead of landlords, because they don't actually have to deal with the land. They have the right to it, which is interesting, but it does sound like it's not tax efficient. So with us who own the land and the buildings, we get to write that down each year as we make money, and it usually offsets the good money that's coming in as being, we always say, it's magic, the magic of depreciation, that, as Tom Wheelwright says, the paper value of the building is being depreciated while your cash is coming in. What happens for you from a tax situation in the world of lien investing or note investing?
Yeah, you're exactly right. Any kind of debt investing you're doing generally is not going to have the same tax benefits that you get through the equity side of it. The kind of only caveat is our funds do not generate unrelated business income tax, because we don't use a little bit of leverage for making acquisitions, but the way that it's taxed is as a portfolio. And so it's very friendly for qualified monies. But other than that, you're right. I mean, it's kind of the one downside, I would say, of debt investing. But the contrast is we are paying a high yield, paying anywhere from 9 to 12%.
Great.
And one of our funds that's got a 9-year track record, audited financials, it's got liquidity, right? Which you can't really get in a lot of private investments. So after 1 year, if you need your money back, you let us know with about 90 days notice. And we have best efforts liquidity, which we've always hit for investors. And so that's kind of, there's trade-offs in everything, right? So
absolutely.
That's kind of where we position it. It's a high yield fund, and it's income, current cash focused with some liquidity, not as much tax benefits, but you use other buckets of money for that.
I love it. Ben, wow. So someone only has to be involved in this fund for a year, because usually funds, you're committing for 3 years or 5 years before you can get your money back. Also, the 9 to 12% is awesome. So that's fantastic. What other asset classes are you guys involved in?
Yeah. And so, kind of rewind a little bit, we started this original fund really as an opportunistic view into what we saw the market doing. And it's kind of formed the basis of how we look at opportunities ever since then. And so, we've been doing this business for a while. And then alongside, we've been investing our own money into other deals. And because, hey, we want to take advantage of depreciation. We want to take advantage of leverage and doing these other strategies. And what we've really kind of cut our teeth in is macroeconomic trends. And so we talk a lot about that in our podcast. And we've done a few webinars recently on called investable megatrends. So some trends that are, not just short-term in nature. And one of the things that we like to distinguish a lot in this research is, a lot of people equate the stock market to the economy, right?
Yeah.
And those are two very different things.
Very
the stock market is a roller coaster. It's generally an emotional pendulum that reacts to news that is coming out all the time. But the economy is like a huge cruise ship, right? It's going a certain direction, and it takes a lot of effort and time to turn directions. And you can generally predict with some level of confidence these kind of, we call them short to midterm trends and things that are happening that are kind of separate from the headline narratives and the newsreels that you see. And so what we're trying to do is position ourselves where we see demographic trends, where we're seeing investment trends, we're seeing geographic trends. So different things that we think are going to continue to occur unrelated to other kind of more emotional.
I love it, and I want to put a point on what you just said there, and you did it better than most I've ever heard. So the markets move up and down based on the really radical predictions of profitability in the future. So then They get priced into the numbers, and plus whatever's going on in the news changes the value of a stock piece of paper. So you have all that happening, but we often think of that as the economy. But I love your point that the economy, which is all the transactions going on every day, doesn't move that quick, you're saying. And so you're saying as long as you're watching the cruise ship turn, you can actually just take your little speedboat and go in front of the cruise ship. So because you said you did webinars and trainings on this recently, how many mega trends have you identified that are commonplace, that you're looking at?
Yeah. So we have 5 that we just did in this webinar, and we actually have a recorded and downloadable for the audience if they want to check that out after. I can put a link to you
love
guys
that.
in the show notes. But I won't go through all of them because it was an hour long and we barely scratched them. But the big one is, it's kind of driving a lot of this is inflation, and that's kind of an obvious one, right? But our prediction on inflation is we think it's going to occur and continue to be elevated for a period of time, if not 18 to 24 months on the low end. We think inflation is here to stay, and it's unique to say that because we haven't had significant inflation for many, many decades. And it's being driven by a combination of a lot of things, which are kind of all interrelated. And so some of the other trends that we've been identifying are deglobalization and some massive changes in how companies, manufacturing and distribution, are kind of rewriting the whole supply chain and the whole manufacturing chain. And COVID caused, some of these trends were kind of starting already, and some of the geopolitical risks that were kind of becoming a bigger issue, and wars abroad, and untenable political relations. It's starting to shift the risk characteristics that some companies are willing to take, and so the supply chain issues that we saw in COVID just really exacerbated this. So Ford Auto Manufacturing is a great example. They manufacture parts in all different countries of their cars. They right now have some major bottlenecks in their computer chips, right? So they have right now, I think it's 50,000 trucks sitting in parking lots that cannot be sold. And I saw someone the other day say, what do you call a truck that has 29,000 parts that needs 30,000 parts, right? It's just an oversized paperweight. You can't do anything with it. They literally can't sell it. So they have, I think, 5 billion in inventory that can't be sold.
Oh my!
So how important is it for Ford to be able to control when those computer chips are manufactured and the timing of those being delivered? It's not worth saving a few pennies per chip to get it, just in time in this, globalized supply chain. And so this calculus is rewriting the entire supply chain in the globe. And it's a whole new trend that we think is going to occur for the next decade at least, because the past 3 decades have been globalization, right? Have been trying to outsource manufacturing and distribution of all components of the manufacturing process to the lowest cost areas. And just-in-time inventory, you have perfect logistics all set up, and then everything arrives right when you need it at the lowest cost. Well, that's super deflationary, right? Because you're shipping off these higher costs to lower cost areas, and generally the globe has benefited from that. But when you deglobalize, it actually is very inflationary. And then the other piece to this that kind of ties into another big driver of this deglobalization is energy. And so another big trend we're paying attention to is energy. We've been investing in the energy space this year and have several more that we're working on right now. We think there's kind of it's a very unique time, right? In this last summer in 2022, we saw some very high gas prices, and a lot of it was related to some geopolitical stuff, but a lot of it was just supply constrained, and then a lot of demand. And kind of going back a few years, the ESG initiatives that have been going on for a decade or so have kind of created this meta narrative of oil is bad, oil is evil, and we need to transition to renewables. Which, hey, I'm great for renewables. Who doesn't want renewable energy? That sounds awesome. The problem is that the initiatives that are being touted are not realistic, and the timelines are not realistic. And so the capital investment as a result into oil and gas globally, this is globally, not just in the US, has decreased by 50%
What?
in the past 5 years.
So this is interesting. I think we should drill in on what you mean here.
Yep.
So drill. Was that an accident or what? But the whole process of finding, prospecting, drilling, refining is so ridiculously capital intensive that
Yes.
you need mega institutional money to do it on scale. And you're right. I think it's Blackstone even is trying to pull out of that because of their environmental commitments. But the irony is if they, it'll actually make everything cost more because there'll be
100%.
less infrastructure. So that now I'm seeing why you believe in a long-term inflationary world, because you're saying there's less of everything, therefore money's chasing less of things.
100%. I mean, the political narrative for ESG is driving these investment decisions that are completely disconnected from the real need that we have, because oil is used in literally everything. I mean, everything you touch and see and drive uses oil at some part of the process. And it's not something we can magically snap our fingers and just transition to, renewables. One little stat that we mentioned recently in this webinar was, of all the vehicle sales, for example, that were sold in 2021, guess what percentage were electric vehicles?
It's disproportionate in our minds because everybody knows somebody bought a Tesla, but it's, I don't know, what is it, 3%?
5%?
Yeah, right in between. 4.4%, I think was the number. Wow. And to create those vehicles, you have to have batteries, and batteries are very expensive, and they use a lot of lithium. And those batteries used 60% of the global lithium production. So wow. 4.4% of all vehicles sold were electric vehicles, and it used 60% of global lithium production. To get to where they want to be, to transition, the majority of vehicles to electric vehicles, we have to produce, the estimates are 25x the lithium production globally, just to hit the very baseline standards that a lot of these environmental initiatives are.
Yeah, I don't think anybody can even really grasp what you're saying. So I can barely grasp it. So you're saying, however lithium's mined, and I was told that it's actually, there's elements within the battery that are extremely rare or scarce, I should say. Yeah. It wasn't lithium; it was cobalt, right? Cobalt is they're difficult, and aren't they typically not in our country? They're in other countries, right?
100%. Yeah, we don't have very many operating. Risk. Yeah, most of the lithium, unfortunately, is in China.
Ironically, yeah.
Yeah.
So Ben, what you're saying is, if I'm hearing this correctly, it's actually worse for our environment creating these electric cars than using gasoline. Is that what I'm hearing?
In the short term, yes, because mining lithium is a very dirty business. It's takes a lot of, fossil fuels, takes a lot of labor, and it's not generally in great environments, right? What I'm saying is it's unrealistic to force this transition to renewable energy in the time period that is the politicians want, because it's not realistic. So what's going to happen? So basically, kind of bringing it full circle, we've had a 50% drop in capital investment, and a lot of politicians go around to banks, and telling them not to fund their lines of credit to other reinvestment projects. Josh made a great point that is very astute, that the way that oil and gas works is a depleting resource, right? Wow. And there's a reason to get depletion, expense write-off in these deals is over time, the same well produces less and less and less. And so if you're not putting money back into it to produce more, inevitably your supply is going to continue to come down. And it's not something you can just flip a switch on and turn the supply back up. It takes, from 5 to 10 years to get these new developments producing. And so you have now supply going down, and, demand has actually continued to stay pretty steady, if not go up a little bit, especially this summer when everyone was doing to get all the travel out that had pent up for the past couple of years. And so what we think is going to happen, and who knows? There's so many variables going on, but right now, the Biden administration is using the strategic petroleum reserves to keep the current supply of oil relatively stable. But that's generally used for emergencies, especially wartime emergencies. And so if they continue to exhaust those resources, a lot of the predictions with the big investment banks like Goldman Sachs, JP Morgan, they're all over the map on where they think oil is going to go, but it's a lot higher than it is right now. And it's something that we think, again, is going to be a mega trend because it's not something that can be easily solved. And, ultimately, we think, it's not really a conspiracy to say the politicians want oil prices to be higher because it can, create demand destruction, which people will change the pattern of usage, but also then makes it more cost effective to produce the renewables. So all that to say, we think there's a lot of unique dynamics going on in energy. We're finding some pretty unique opportunities. And, kind of bringing this back full circle, I was saying at the beginning, these are all interrelated. You know what the number one driver of inflation is right now? It's energy prices, right? And so if energy prices continue to be elevated, the Fed's going to have a very difficult time stamping out inflation. So there's other things we're tracking too, but those are the biggies.
A lot of good points there. What is it that you do? What tools do you use to stay ahead of the trend? Because I'm hearing a lot of predictions, and it seems like you've done a lot of research. What are you using to get ahead of this stuff?
Just read a lot. So, yeah, a lot of it's done with Bob, my father, and myself. So this is just our hobby. This is what we love. This is, it's all we talk about is economic trends. And we do on the podcast a lot. So it's just what we're tracking. We read a lot and kind of formulate our own.
I can digitally hear people clicking subscribe on your podcast right now. Invest Like a Billionaire. But let's go to the final section. Ding, ding, ding. With that mega trend, that gigantic cruise ship turning, and you see where it's going, what is in front of that you can be an investor in?
Yeah. So energy is a great example. We did a deal just a few months ago, and, investors, it makes sense, right? Especially in the summer when you're seeing gas prices hit $5, $6 a gallon.
Absolutely.
You're feeling it and it's happening. And the common sense stuff, it's like, why are we doing this? Why are we, demonizing this transition to renewables? And so people get it inherently where you can position yourself. It's a really unique environment in the capital investment space in energy because the banks aren't lending as much because of these ESG initiatives. And then private equity is a little bit hesitant, right? Because oil has been very volatile the past few years because there's just so many dynamics going on. And it's, when you're a big institutional investor, volatility doesn't really help with your mandates a lot of times. And so we're kind of finding opportunities in a few different areas, but kind of going in these, smaller plays. We did a big acquisition of vertical wells. So these are, vertical, the standard pumping units that you see on all the graphics. And producing wells is producing at a great cash flow. Right now, not as we speak today, oil's about $90 a barrel. It hit about 120, in the summer. And, our break even on this is about $30 a barrel. Wow. So we have a huge margin, and everything else above that's profit. And then we're it's kind of like value add real estate. We're buying existing wells. We can do some kind of value add to it. We can do some workovers, what they're called, and make these wells produce more by just simple maintenance and mechanical changes. And then we're drilling several wells on the project so that we can continue to boost production and, force value, if you want to call it that. We're looking at some mineral rights. So mineral rights are a way that you basically own the rights to the minerals and you lease them to operators. And so we're looking at some natural gas plays in the Haynesville Shale and Louisiana, you buy mineral rights and leasing them to, tier one operators. So there's lots of different ways to play it. I will say, I think it's a good time to be in energy, but energy and oil and gas in particular, there's been a lot of bad actors in the past. And so people, a lot of times they want to invest in it, but they get a little bit nervous, and rightfully so, because there's, we're doing all our due diligence originally. One of the consultants said, the classic idea for oil and gas investing is you have a liar with, on top of a hole, and they're basically just talking about all the things they're going to do, and it doesn't actually materialize. And so, you have to be careful when investing in this and doing the right due diligence. But we think it's a great place to be right now.
Ben, this has been incredible. As we're heading out to sea in front of that cruise ship, would you mind sharing a little bit of how we can follow up with you, the best way, and maybe give us that download? How should we get that download on the or not the download, the training on the 5 megatrends.
Yeah. So we actually do have a download and a little like mini video series, just breaking down the webinar in little bite-sized chunks. So I'll give you guys the link. So I wasn't prepared for it, but we'll make sure it happens after the fact. And then, the podcast is a great way for folks to kind of follow along with some of our thoughts on economic trends. Invest like a billionaire. You can find it on any platform you're listening to podcasts, and those are the best ways.
Awesome.
What a powerful show. We're starting to consider branding this. Well, we've always called it the Audio Mastermind, but it's like the alternative investing Audio Mastermind, because it begins with, first of all, you guys deciding that you were going to get ahead of megatrends. You put your talent, your time, and your treasure into that training. And now you're out prospecting for us, right? If we were to join you, this is what I love about small private investing, like we all do with retail investors. We're your workers going out there, and we recognize that responsibility. Melanie and I put the name Accountable Equity on our business because we're like, we get it. It's your equity and we need to be accountable. But that's what you're doing, prospecting into these trends, and you're going to provide access to it. So we appreciate what you're doing.
Thank you so much, man.
Likewise. I love what you guys are doing. Appreciate getting to chat with you all.
Yeah, it's absolutely awesome. We'll talk to you soon.
All right. Thanks.
Bye.
Thanks.
Damn straight. We just got
buddy.
We got to the end of another great show. And everyone listening right now, you're the family and friends. Thanks for staying till the end.
That was so fun. And hey, hit the like, hit subscribe. We're here to serve you guys. That's why we're doing this show. Josh is not paying me. I'm doing this off of my quote unquote sweat equity because we want to make a difference in your life. And then that ripple effect will continue to touch the world.
Hey, amen, brother. Please check us out on capitalhacking.com, all the social media threads. And yes, I know you've probably already sent this episode to one of your best friends. Thank you. We love you. Just go right into your iPhone, hit the plus symbol. We'll talk to you later. See you next week.
Share.